Indian equities have been on a shaky ground for the last 1 month. The Israel-Palestine war has further deteriorated the outlook, which was already weakened by rising crude and US bond yields. Oil prices are back above the $90 a barrel mark, up 7% in the last week, while US bond yields are hovering at 16-year highs of 4.8%. Concerns that the conflict could widen and destabilize the Middle East are also stoking fears of a market correction. The ideal strategy to navigate the current market is to stick with large caps over the mid cap and small cap segments, which have seen a meteoric rise this year, analysts say.
Certainly, yes. As a research analyst, I would give a equity strategy of parking minimum 50% Sensex and Nifty stock, or at least to top 100 or at least to top 200 stocks, preferably top 100 stocks, 50%. And then, my equity research strategy would be minimum 5 to 10% cash, 5% in gold ETF. This should be the strategy because, oil price is already up 26% from the bottom. Now, yesterday, there are reports that fertilizer prices are shooting up in whole of Africa and some Asian countries. That is also a big risk factor for India. And then you have the state election, then forthcoming general election. And the valuations are highly, in a bubble zone in many small and mid-cap segments.
At the bourses, the Sensex benchmark, which constitutes large caps, is down 2.3% since mid-September, when global markets began to price in higher for longer interest rates. In comparison, the BSE mid-cap index is down 0.6%, while the small cap pocket is up 1%, respectively. Analysts at HSBC expect a market correction, if any, to be sharp and short-lived. India's strong outperformance has met some resistance from rising crude, firming US bond yields, and inflation risk. Mid-cap rally also warrants some caution and leaves large caps relatively more appealing and candidates for re-rating, said Harold van der Linde of HSBC in a recent note. Additionally, a potential correction may not see the large caps experience a significant fall, given their limited participation in the market rally, notes Chokalingam of Economics Research. The likely support of domestic institutional investors also provides a cushion to Sensex and Nifty stocks, he says. Evidently, in September, large cap equity funds saw 68% lower outflows from August, while higher redemption led to a 37% and 20% decline in inflows of small cap and mid cap funds, respectively. Thus, investors may keep their current portfolio allocation tilted more towards the relatively safe large cap segment. Today, on October 17, Dalal Street action will be guided by the Q2 earnings season and global market sentiment.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.